We've hit 54 new highs for the S&P 500 this year, and we still have a little under a month to go. We're seeing powerful momentum in a wide range of market sectors. We're watching investors largely shrug off scary-sounding geopolitical headlines. But is all that a good thing? Are there risks that markets are not appreciating or anticipating? Today's Money Show MoneyMasters podcast will feature an all-new guest weighing in on these questions. He's Steve Sosnick, Chief Strategist at Interactive Brokers. Steve, thanks for joining us.
Thanks so much for having me. I'm very excited to be joining.
Yeah, great. Steve, I haven't had you on the podcast previously, so why don't you start by talking a little bit about your background in the business and what it is you do at Interactive Brokers?
Sure. My current title is Chief Strategist, Interactive Brokers, as you mentioned in your introduction. I came about it through a long career in trading. I started at Solomon Brothers, in the late 80s. I was a training class or two behind Michael Lewis. Just so I went through that. So for those of you who've read Liar's Poker, you kind of know what my life was like the first year or so of mine in the business. I was there for a few years in one of those you know, late 80s, early 90s kind of moves. Lehman Brothers poached my department, which was kind of a cool thing at the time, but not maybe necessarily the best. It was well before the firm imploded, but
Sure.
that was when I learned the lesson. You don't necessarily take a job just because they pay you more. So I was there for a couple of years, then went to Morgan Stanley, but realized that my real passion was for doing stuff for algorithmic type of trading and developing trading models, rather than customer facilitation. And so when the job came open, this would have been December 1995. When I learned about an opening at this option trading firm called Timber Hill, which was basically an index option trading firm that had just got into equity option market making, and they knew what they were doing in terms of electronic trading, but they didn't have a lot of people with relevant equity risk management experience. And so I basically signed on with Timber Hill as their equity risk manager, basically working at headquarters, what was then Westchester, New York, now Greenwich, Connecticut. Basically, we had these models and we were sending out, we had prices that we were sending to our traders who were on the floors at that point. And they would, enter, basically be making markets based on the prices we would send them. The orders would get executed. They'd get sent back into our model in Greenwich, and we would be constantly readjusting the model. And, obviously that firm, that little relatively small firm, grew into what was at one point the largest options market making firm in the world. And along the way, we changed the name to match the small venture of a brokerage firm that Thomas Petterfy developed, just to sort of as a way to ensure that we might be able to get order flow for our market making, and thus Interactive Brokers became the name of the company. And I've been there ever since. Now, at some point, you've been in the business a long time now. I deliberately kept a very low profile. When you're a proprietary trader with a pretty, helping manage a pretty successful model, you don't want to be out there too much. It doesn't behoove you to make too much noise. But I'd made some content, obviously been in the business a while. And at one point, my friend Steve Sears, who I knew from when he worked at the exchanges, was writing the striking price column for Barron's, and went on vacation one week and said, "Have you ever tried writing a column?" I said, "No, but I'll give it a try," and got permission to do so. And I guess it went well. So he asked me to do it again. And it's sort of like in the spirit of the old Tonight Show, I became kind of the permanent guest host, for lack of a better word, which continues to this day. I literally wrote the current issue of his column in the current issue of Barron's. That's on newsstands now, or on the web now. And I guess if you start doing stuff like that, then other people take notice. And so someone from Bloomberg said, mind if we talk to you? And I talked to some, again, how to get permission to do all this. Talked to the people from Bloomberg, and then they said, "You know what? We have this. Would you like to come and talk about it on TV?" Okay, that seems like a good idea. That seems like it'd be fun. And that turned into a pretty regular gig. And so I I morphed from proprietary options trader and market maker and specialist and managing the risk. Basically, my main role in our options market making was I was specialist in several hundred different names, mostly financials. I ran our Canadian business, and most importantly, I was pretty much the guy responsible for making sure we didn't blow up.
Oh,
And so I'd say that part works pretty well, at least the not blowing up. And but then as we started to de-emphasize options market making because it was not, it was not what the analysts from a public company point of view don't love market making because it's very variable. We never had a down year, but we had up and down quarters, and they couldn't model that.
yeah.
And so when the proprietary business was phased out, and actually later the U.S. business was sold to Two Sigma, I stayed behind because at this point I was, public facing and basically spending most of my time writing about and talking about markets, primarily option markets, but I have a very broad mandate. And so here you find me.
Great. Well, it's a long and winding road how we all end up where we're going. So appreciate the background there. Great to hear. Now, I want to ask you, Steve, in this market, I mean, let's talk about what I was introducing there. I mean, we are seeing new high after new high. We're seeing volatility, and I love the term you used in your recent commentary, slouching here. What's going on, and where do you see things headed?
It, this is very much of a momentum driven market, and you alluded to it in your intro, and it should be obvious and evident to anybody who's paying attention that at some level it's going up because it's going up, and that's in many reasons a great time to be trading, but often a very poor rationale for investing. um, and that's why in the most recent column that I alluded to for Barron's, it was basically don't fight the tape but insure it. And my feeling here is by several different measures, we're getting stretched.
Yeah.
You can pick your fundamental, measure, and and the market's expensive. Whether it's phenomenally expensive, bubblicious expensive, or just plain old expensive, that's a matter of some debate. And what I will acknowledge is, as someone who's paid attention to fundamentals for decades, they're not a good timing indicator.
Yeah.
Stuff can be cheap for years or more. Stuff can be expensive. The old adage, market can remain irrational longer than you can remain solvent. I'm not saying we're at irrational levels. Let me be very clear about that. But I do think, after 2 years of sequential 20% plus gains, and a point where let's call it the earnings yield on the market, the E to P ratio, which is a very simplistic measure, but in some ways the most obvious one,
Yeah.
where the earnings yield is lower than the Treasury bond yield. You might want to start thinking about maybe we've kind of run our course, and it's very interesting because we had that furious rally after the election. It's understandable why, but lately we've really been, for the most part, kind of grinding around, and that's where sort of the slouching term came in because it what I see in a lot of different days is, like, we're taping this on Tuesday. So yesterday, Monday, we had, the markets go up, not particularly with any great conviction. They sold off
Yeah.
overnight because of some news in France. U.S. investors are very good at ignoring news from overseas, and so they did once again. And the Mag 7 went up, but you had actually more stocks declining than advancing. And you do see that pattern a lot of times where as long as the right stocks go up, it doesn't really matter that this big breadth expansion that we had could be fading. So and also quite frankly, is there anybody right now who's saying that who fears a bear market? You don't hear it.
Yeah.
And so as a contrarian, I do, again, I always respect the message of the market, but I do always have in the back of my mind, be greedy when others are fearful and fearful when others are greedy.
Yeah.
And people are greedy. And so I'm not necessarily fearful, but I'm cautious.
Yeah, fair enough. When talk to other people that, or listen to financial TV, the main reasons you hear behind the rally, you've got, business friendly policy, given the election results. You've got, some people looking at seasonal strength you typically have this time of year. And some people talk about hope for Fed cuts. I mean, not just later this month, but into 25. Any thoughts on those individual factors? I mean, do you think they're being over anticipated or overweighted, or do you think it's fair to be bullish based on some of these drivers?
Fair, but prices move at the margin. So have you told me anything that's not factored in? And that's not a knock on you. That is
Oh,
just
sure.
right. I mean, okay, business friendly climate. We priced that in the run up after the election. Rate cuts. We've been until recently, where it'll be interesting to see what the next dot plot says. The market's been way ahead of the Fed in terms of expecting rate cuts. It's finally sort of changed a little bit. We'll see if the Fed backs off because the inflation numbers haven't been as friendly as the market had hoped, and the jobs numbers, fortunately, are not as bad as feared. So that may or may not be priced in. A lot of people saying, "Oh, one of the great reasons to invest in the market is, the S&P is we're expecting double-digit earnings growth for S&P next year." Well, that means it's priced in already.
Yeah.
So what? So this is my problem. Momentum can last a long time, and if you think from a factors point of view, which I'm not an expert on factors, so I'm not going to hold myself out there saying, I'm the factors guy. But when you break the market down into factors, the one that has been most consistently outperforming, so to speak, is momentum. And so to me, what that means is if we're all expecting, call it 15%-ish earnings growth for the S&P next year, that's phenomenal. Okay, but that means it's relatively priced in because that's in there in the price. And that's why you see stocks freak out when companies' guidance doesn't meet the numbers. It no
Yeah.
longer really matters whether or not you have to beat your number, but in an environment where 75% or 80% of the companies beat their number, that's a necessary condition for a rally, not a sufficient condition for a rally. So people are starting to look beyond the EPS, and they have been looking more into revenue for some time, but now it's all about guidance. If a company even gives a whiff of bad guidance, because you really have to adjust your forward numbers. And so this is where I sort of wonder, like, okay, what's left? What good news? What good news? There's a lot of good news priced in, which is
Yeah.
which is why I'm not saying the market is a bubble or anything of that nature. But what it means is the easy the easy yardage has been gained. Now it's more of a now we have to grind it out. We have to make sure that we actually do get the Goldilocks economy or the soft landing, whichever scenario you prefer to say, which allows, for moderating monetary conditions at the same time allowing pretty robust profit growth. If we're talking about 3% real GDP growth, which,
Yeah.
by the way, in my mind, doesn't necessarily scream we need more rate cuts. But let's say we have 3% real GDP growth. Let's say inflation is in the 2 to 3% range. So that's called 6% nominal growth. Okay, so where does the other 9% growth come in for the S&P 500? It could. It's tough it's very difficult to bet against American management. They're very clever. They're good at finding ways to improve. But again, this tells me that there's, we're getting to the point where I worry that we have to draw to an inside straight. Um, I've mixed like 100 different metaphors in here. I apologize.
That's okay. I mean, in Las Vegas, we're going to be trying to do a poker night, so
There you go.
that would fit right in. So let's talk about that. You mentioned the thesis, and I love that headline in the Barron's column. Don't fight it, insure against it. So what does an investor do if your sort of thesis plays out here? What's the best move as an investor or trader?
Well, my in general, always the first thing to do to de-risk. People always ask, "What's the best thing I could do to de-risk?" And that is take some money off the table. In an environment where short-term interest rates are basically you're actually we're not used to this, but you're getting some real interest rates for a change. If you're nervous, take some off. You've got now. I understand there's tax consequences to it, and that's probably why through the end of the year, there's not going to be a huge pressure on the market, barring some exogenous factor, because no taxable no taxable investor really wants to be selling now. Number one, just because tax policy usually says, so, get your losses out before the calendar turns, and get your, wait for your gains till after the calendar turns. Secondly, I think people will want to see what the momentum is in terms of any potential tax cuts, or at least whether, I think that the one thing that really did justify the recent rally, by the way, is the idea that, differing tax policies between the Democrat and the Republican administration. So there's that factor to it. But maybe don't put more money in at this point if you're ready, where you are. Then the next thing is, and that's why I use the term insurance. And the strategy I laid out in the article, and it's not one size fits all. And you'll never get that from me. It's just not something I do, because everybody feels differently. Figure out what your risk tolerance is and be honest about it. Because, I think a lot of times you have, like, think about the day in early August when there was the carry trade implosion and people freaking out. Some of that was forced selling, but a lot of people were getting very nervous. And if you were very nervous on a day like that, well, that to me, if you get nervous on a relatively routine drawdown or something slightly bigger, that should be your signal that you're carrying too much risk. So figure out what your risk tolerance really is. Are you trying to insure against a 5% drawdown? Are you trying to insure against a 10% drawdown? Are you trying to insure against a catastrophe, 15, 20%, that kind of thing? Figure out what that is. So that's your deductible, if you want to think about it in those terms, right? Like when you're buying insurance on your house, am I willing to bear a $1,000 loss before my homeowners kicks in? Am I willing to bear 5,000? Am I willing to do a 10,000? If you're in the, maybe you want to, maybe you want to almost self-insure, but you understand my point there.
Yeah.
So then you figure out, and as with insurance, the lower the deductible, the higher the premium. So what it means is you have to buy options that are closer to the money and therefore more expensive, more cash outlay. Now, one thing we have seen is at money volatilities are relatively low. We see that from VIX and we see that from other different measures. The skews are actually relatively steep, meaning that out of the money puts have their implied volatilities, if not having risen, they've certainly remained firmer than the at money volatility. So you're not alone in putting on this trade. But that's kind of why I advocate then looking out 2 to 3 months. And there's a reason for that. And it has to do with decay. And it has to do with my thesis about short-dated options. We've all fallen in love with short-dated options. I don't have the current statistics in front of me, but I think options under 7 days to expiry are certainly majority of the option volume right now. But my commentary on that, and I don't want to steal thunder from what I intend to talk about in February, is those options are both the cheapest and the most expensive options on the board. And my reason for that is they have the lowest price because they have the least time. You're not paying for you're paying for very little time premium. Yeah. But the one thing but decay is nonlinear. One of the first lessons I learned way back when options only expired once a month is, your decay falls off a cliff once you get into the expiration month. And those were options that were expiring 2 to 3 weeks out. So, think about it when you're talking about options that are expiring shortly. And of course, on the final day, 100% of your time premium. That's very few guarantees in the world of options. One of them is your time premium will be gone by the end of the day. If you're trading an expiration day. So sure. That's where I say that from a percentage, you're not paying a very high price for those options. You're paying very low premiums, which is why they're very appealing. But as a hedge, they have drawbacks because you're really fighting decay. And you have to be continually hedging constantly. You can't take a break. You can't not do it. Whereas if you look out 2 to 3 months, yes, you're spending more money on the option, but you're not really, you're protected. If you have an overnight move, it doesn't really moves in your negative move. It moves in your favor, not not saying, oh crap, I now have to buy these more expensive options. And I then advocate rolling them 6 weeks to a month to 6 weeks before they expire, so that yes, you've lost some time decay, but you haven't really hit that exponential decay period. And it also means, again, you don't have to be pushed into a decision. You don't have to say, oh man, I have to rehedge this insurance no matter what it costs me. You're up, you're down. It's no big deal. And remember also with insurance, that you actually don't necessarily want your insurance to pay off, depending on what type of insurance you're buying. Certainly, I don't want my life insurance to pay off anytime soon. And realistically, I don't want to put in a homeowner's claim. I don't want to put in a collision claim. Options are a little unusual because in insurance, there's the concept of moral hazard. No one will write you an insurance policy if you have an incentive to make that policy pay off, right? If you're an arsonist, good luck getting a fire insurance policy, right? In the options market, you don't know who particularly this from my life as a market maker, I didn't know who I was selling insurance to per se. Obviously there's rules against insider trading and the like, but for the most part, I don't know who it is. So whereas again, with insurance, I can't insure my house for more than it's worth. In options, you can insure your portfolio for more than, you can insure yourself 110, 200, you can insure whatever you want, relative to your portfolio. But so this is why, if you're thinking of it as insurance, as buying protection on a piece of your valuable asset, which is your portfolio, think about it in insurance terms. You don't necessarily want it to pay off. You don't necessarily, unless you're over-insuring, right? If I'm insuring 50% of my portfolio value against a 10% loss, I want the market to go up, which would mean those puts, I'm continually buying some puts that are expiring, but I'm giving up a little bit of my return to sleep at night.
Yeah.
And so that's kind of the way to think about it.
Okay, fair enough. Stephen, the last minute or two that we have here, you're going to be joining us for the 25 Money Show Traders Expo Las Vegas. That's in February. I know markets can change dramatically in an hour, a day, or a week, much less a couple of months. Can you give viewers a quick preview of the kinds of things you're going to be talking about there? You talked a little bit about the zero DTE options. I'm just kind of curious what other things you might cover.
Well, I think we'll start to talk about I think I'd like to talk about, speculating in options vis-a-vis hedging with options. I think the options markets developed, and I sound like a cranky old man here, but options markets developed as a means of risk transfer and hedging, not purely, yes, you need speculators to make it go, but I think we've kind of morphed into using options as speculative tools. And I want to refocus people on the other characteristics of options, because I think we've fallen a little too in love with the speculation, and that falls into the general momentum trading. I think I'd also, depending on where we are at the time, I always want to talk about the current volatility environment, potentially talking about how correlation affects volatility indices like the VIX, which have a lot more to do with correlation and dispersion of the S&P 500 index, I think, than most people realize. Short answer is, if you have a two-stock index and both stocks move in the same direction, that's full volatility. If you have a two-stock index and they move in opposite directions, that's zero volatility.
Yeah.
Obviously, it's a lot more subtle when you're talking about a 500 stock cap-weighted index, but there's the basic point. So and of course, definitely, how to sort of read things in terms of, option skews and options, to get a sense of the risk that other people may or may not see in the market at any given time.
Got it. Well, Steve, you clearly have a lot of insights to offer. And viewers, if you're watching this and you want to learn more from Steve, he is going to be speaking at the Money Show Traders Expo Las Vegas. That's February 17th to 19th at the Paris Las Vegas Resort. You can find out more by clicking the link in the video description below. And don't forget to like us. If you like this video, subscribe to our Money Show channel here. You'll get updates like these in between events. Steve, again, thank you so much for joining the podcast and taking some time out.
Thank you so much for having me. I look forward to seeing you in person in a couple months.
Perfect. Take care.
Take care.